All right, greetings there, traders. Sam here from TradeDevils.com and TradeDevils-Indicators.com. Today, I'm pleased to introduce to you the latest addition to our suite of tools for NinjaTrader 8. This is the Devil's Volume. Now, I have in front of us here, this is a 1-minute chart of the NQ, and on the chart here, as I often do, I have our toolbar, as I'll grab some tools from that throughout the course of the video. Now, I also have, well, I actually have our opening range and initial balance indicator on, but I've removed it to avoid distracting from what I want you to focus on here. So the only thing I have highlighted and turned on here is the open of the day. Now, as I often do, I never cherry pick anything. I typically record these on the weekends when the markets are closed. So I just always use the last couple of days of data, so there's never any, any suggestion of any cherry picking. There's never any need to. What we're teaching here is so pervasive. It's happening on every time frame in every market. It's just very, very consistent. Now, to speak specifically to what we're doing here with the Devil's Volume, it's a bit of a combination of volume spread analysis and some techniques that were really pioneered in the Forex markets as a result of the fact that Forex traders, they don't actually get true volume. What they get is tick volume. So as a result of the fact that the large players in the FX market they're trading such tremendous size that they really have to pay attention to where they can find liquidity so that they can execute without disrupting the market too dramatically or tipping what they're doing too dramatically. So this approach, it really is blending those two ideas, those two concepts. But what you'll find here is that it's very consistent with what you'll find happening in the futures market as large players look for liquidity and take advantage of that. So what we're doing here with the Devil's Volume is identifying those periods of in this case, since we're using a time-based chart, we're getting volume at time, right, rather than volume at price, which you might do with a volume profile. And again, because Forex traders, they don't get a true volume profile, they get a tick volume profile if they get that at all. They developed this technique of identifying the high volume bars, right? So where market makers or institutions would recognize that there was high volume. So that's exactly what we're doing here. So, let's see. Well, we might as well start here at the open. Now, I am using hollow body candles. Some are familiar with that, but I use them because in a template where I would apply this, often we're giving additional information inside the bar. But if you weren't using any of our stuff, you could just as easily put it on a candlestick chart, right? So the bars are going to stand out. But I prefer it here over, and I've gotten quite used to the hollow candles. So that's the reason why. Well, if we just look here, it's relatively straightforward concept. So all we're doing here is just identifying with green and red bars here. So we see a green bar here right at the open, not surprising, and a red a red volume bar here tied to this red candle. Well, the green and the red, that's 200% the amount of volume of the prior X number of bars. Now, I currently have this set to 5 bars, but you can play with it, experiment, do some testing here with whatever period you think would suit your needs. We find that in the 4 to 5 range, where it might. So if you're familiar with what a fractal is, you might get a fractal within 5 bars. So that's why I'm using 5, a fib number. I mean, again, experiment with whatever you'd like. You'll find different results with them, so it's important to fine-tune, do some experimenting. I think you'll find 4 to 5 will be a number that will offer value into your analysis. So for example, here as we look at this red, we can identify it down here by the red volume bar here. We know that if I were just to look back 5 bars, that's 200% higher volume than the prior 5 bars. Right? So now if I come to a light blue bar here, I've got 150% the volume of the last 5 bars. If I come to a pink bar here, that's 150% of the sell volume of the last 5 bars. Right now, now back to volume spread analysis, this would be what's called a churn bar. So we have very high volume, but we have a very narrow spread. And this is often you'll find these at turning points in the market or pauses within the market. So we want to identify these because the market is talking to us here. This is not insignificant. So these bright yellow churn bars here are significant, but the others are as well. And so the color coding of the bars is really just to draw your attention to where these potential pools of liquidity are, because they are used by traders that are looking for areas where size can be put onto the market. It doesn't necessarily always have to be massive amounts of size, but players that are looking for liquidity pools, could be market makers, could be, it could be any of the liquidity providers that are in the market. These are worthy of your attention. So let me give you a couple examples so you can kind of get in touch with the concept. Well, let's see if we go. I suppose this is as good as any right here. We'll go through several examples here just to get the concept here. So let me just use my little drawing tool here. So here within the context of this bar, right? So we can see it identified by the green bar here. So I know I have, and I can just see it, extremely high volume down here. Now, you could just use the regular up-down volume, and that's going to stand out. But what we're doing additionally is we're drawing the rectangle off to the side, and we have it set to where it will stop drawing once the range of this candle is breached. So, for example, here, if you were, again here I'm. We're kind of coming out of the lunch hour here. So here's if you look down here, this is just after 1 o'clock, so the lunch hour is kind of fading. We get this nice big push here of volume, right? And it's kind of coming out of nowhere, right? Now we had some increasing volume right here at 12:50, but as the market is pushing up, now here's the big surge at 1 o'clock, immediately followed by a churn bar. So the market is digesting that for a minute. Well, what you'll note here is that what the market does is here's the big push. So, I mean, that's not insignificant. We'll look at what that is specifically. But note on the retrace, right? We're coming right back into the range of this big candle. Now we go up again, and at the very top here, now we get another push of volume, gets it up there. So, so what does that look like? All right. So if I just were to do this right here, right? So you see the. Oh, if you've studied some of our material before, you know that this is, as we call this, the dominant algo in the market, right? It's right there, right? That's all the market ever does, ever. At some degree, if you follow any of our videos that are on YouTube, you hear me say that a lot. This is all the market ever does, ever, right? It's always just variations of that, up or down. That's all it does. Or if we're getting a bigger move, it's a combination of these being strung together, right? It's very simple, and I make a point, or people say, well, duh. But I make a point of emphasizing this because if you just bring that frame of reference to everything you're looking at in the market, it will simplify it for you. I think that's why I make a point of demonstrating that here. So well, now that you see it here, right? So so if you were sitting right here, okay, what do we see? Well, I've got a 20 period. This is actually I've got a 21 period McGinley, but an EMA, even an SMA would be an approximation of this. We just like the McGinley because it has a little volatility component built into it. But a 21 period EMA would get you something relatively close. So if you for whatever reason, you're call this up here. I'll just kind of draw it out. Well, here's the lunch hour where we're really not doing anything. Well, here's noon coming, and then here's the push. So here's essentially from noon to 1, right? The time where most traders would say this is not a particularly good period to be in the market because there's so much chop, and you can see it here. We're going sideways, but all of a sudden we start to drift, right? Look at the McGinley line. All of a sudden we're starting to get some acceleration, and we're starting to get some distance from the McGinley line, from the 20 period, or 21, I should say. Okay, so as we're moving up here, now here's the first push up. If you were unsure and you missed this for whatever reason, right? You just, maybe we're just even here, right? You don't want to buy market before it retraces. I personally never buy breakouts, right? So I'm always looking for, oh, something's happened here. I'm looking for the retracement for entry. Right, same thing happens over and over again in the market. So as we see this phenomenon here, you can see it comes back here, and it's tapping into that liquidity. Now, as we push out here, now here's 150% of that volatility, or pardon me, of that volume. Now here again, I've got another big candle here, and you'll look here how quickly So you see it here. Now it's quickly, the low of it is tested. But note the 21 McGinley, right? How nicely that contains it. So here we have this volume, and really you could almost, and this is how I often, before we developed this, I was doing this all day. All right, I was just drawing these across, saying, okay, well I know I've got a liquidity pool here. If they're going to push higher here, you would anticipate that perhaps something like this is what you'd be looking for. So we might get a push up and then a push back, grab that liquidity, and we go. Well, we don't get it here. In fact, we just move sideways, and ultimately we get a push down of volume here, so we get the sell volume. So all of a sudden, sellers get aggressive here, and they push it down. Well, kind of back where I was before, if I were to take this and bring it over, right now, we didn't quite get to that pivot, but this would be an area where you might be looking. So if I just kind of bring up that same fib measure here, you'll note here from the low of this bar, if I'm right on it, if I get into the low of this bar where the volume started, as we come back, what do? Golden zone. Now, you might have been reluctant to take this here, thinking, oh, wait a minute, hey, we're below the 21 period. All of a sudden, am I sure I want that? Well, here, as we, again, this is just personal preference and how you like to enter and what you're looking for approach criteria. Now, the push back above the 21, now the little retrace here, and now here I get another big surge of volume, right? And then we go into one where I've got an even higher surge of sell volume. Now, take note here because it looks deceptive to your eye. So you'd say, well, wait a minute, that's way higher volume than was here where we had this bright green bar here. But remember, that's sell volume here. So that's the largest amount of sell volume from the prior 5 bars. So if you count back, so even though it's higher volume, it's not relative to this. It's relative to, when's the last time we saw that much sell volume? All right, well, here was the last one. So let me clear that up here, and we'll just kind of stay with the concept, and then we'll look at a couple of examples. So here, where we get this high volume bar, you would anticipate if this was really going to be a breakout push, that this would be somewhat unexpected here. That we had, and this is something that happens throughout the course of the day, right? As algos and institutional players and high frequency traders are there. This is a common theme that you'll see where there'll be a push up to bait in breakout traders, and then they'll crush them down, right? So it's I often will tell my traders that as we're working through the day together here that anytime you see a quick up move here, it's almost always a tell to fade it because they're baiting. This is a baiting move. So it goes up here and then quickly is crushed here with very high volume. But note now we come back down here, so we get another retracement. And again, if you pay attention to fib retracements, right in the pocket, right, we get second target here. So here's the push. God, you probably got a second one in there as well, right? So it looks like you got that one as well, right? So if you weren't, oh shit, if I'm right on it, get right on that low. Oh, you might have a slight break here, but well, here's the push to get that one, then this one, then this one. So all of these are getting hit. So it's just one more way to say, hey, am I comfortable taking this here? I've got the criteria. So I've had a push in volume that was quickly rejected and tested. They've come back to the consolidation. You might look at this and say, well, that sure looks like some consolidation here. All of a sudden I had a period of low volume, but then as I come out of it, I'm getting a big boost of volume here. So up they go, right? And they get second target there. Let me clean this up a little bit and get this one cleaned up. All right, so you see then eventually here we get the change of character here, so we've got a big push up here. We're looking for high volume, but what that's doing is most likely we're just tapping into the volume that was up here at the high. All right, same thing here. Here's the down volume here. This is a bit of a fake out, and then it's quickly recovered back down. Let's see if you drew it this way here, back down here and pulled it over here. They're tapping the liquidity that was here on this green bar. Then there's one last push. They can't get to a new high. Now we're at the end of the day, and there's the big sell-off here. You'll also note here up at the top, just to show you a great example of how consistent this is and why you want these to pull across the screen so you don't lose track of them. Look what that's pulling from. Right, the high of the overnight session, right? So this, you can't even see it down here, but you know it's there because it's marked. That's a green green candle right there tied to there. You can't see it, but there's a green candle down there. I wouldn't be able to show you the whole thing going across. So that pool of liquidity that was at the high of the overnight session is tapped into just before the drop at the close. Really remarkable. And then here's another one. If we look pre-market, and some good examples here. Oh, let's see. Let's get it so you can see it. Oh, certainly useful to your pre-market. So here you can see the red candle down here. Of course, right, whenever we have it, it's going to draw this across. So this is high liquidity here. We're below the 21 period. Now look what happens here. So they stay away from it, away from it, away from it, away from it, away from it. Right here is where they get it. They re-tap that liquidity here, right, and that sends it all the way. Then at this point now we're into the open. So actually here's the open. We get this series. Well, this is a series of measured moves, right? You can actually see it. It's just swing, retrace, swing, retrace. These are all golden zones or 50s. We go into that higher pool. Now, if you're just trading and you're not paying attention to that, well, I mean, how would you know? Well, there's a couple of ways, right? Here, I mean, here's a classic measured move right here. Okay, so here's a little front run here. So this is big push down, 150% of the usual of the sell volume of the last 5 bars, brings it down. We go golden zone. We're kind of tapping back into this liquidity, and then up we go. Here we get target as we're reclaiming that liquidity was at that high. So if you were right here, well, you'd have a couple of things telling you, hey, perhaps this is an area to be taking some profit. Now, how much is there, right? Pretty good trade, right? If you got right up into that, what do you got there? That's oh, is that right? Yeah, we'd have 300 ticks into that high, so you'd pull a little over $1,000 right there on a single contract, and not hard, right? I mean, some of the reasons I put on the 21 McGinley here, or again a 21 EMA, is that often we as traders we complicate things so terribly much that often just in simplifying, all of a sudden the market really gets, I think, easier to manage rather than all of the hyper complication that we as traders thinking it's going to give us an advantage. But if you just looked at the end of the day, was this a difficult day to trade? I mean, even if you're just using a 20 or a 21 period EMA, always easy after the fact, isn't it? Right, frustratingly so. But so what we're doing here is trying to help with that decision criteria as to where we want to be looking for entry based on prior volume. So, oh, let's go back another day here. I think you're getting the concept. Well, here's a particularly good one. All right, so here's this. Oh, that's 8:30 in the morning. A huge drop. All right, just massive amount of volume, right, that pops in here. Well, look what happens in the next bar. We go right back here. We're about halfway through it, right, to tap into that liquidity before we come down. Now back again, tapping all that liquidity there before we head down. Right, very common that you'll see that. And you see it, I mean, on a much smaller degree, you see the same thing happening here. So same idea, right? So here we push up, we're coming back down, we're tapping into that liquidity, right? See the green candle down here? We're just tapping into that liquidity. Oh, are we good here? Look at the 21 period. 21 period. All right, I get another green candle here. Up, 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 up. Right near the pivot high, we get a churn bar. Very high volume, relatively high volume, but the very narrow spread. Right, little VSA for you. So that's the setup before the massive fall. And now here you can say, well, hey, well, it blew right through that. Well, on something like that, right, there not much is going to stop that, right? That was obviously just a massive dump of size, and no one there to be on the other side of it here. But you'll again note, if your eye will start to see these very, very regularly as we retrace. We're just tapping into that liquidity, and then down we go. Let's go back. Oh, here's. Let's find a. I would find a particularly good one. Oh. Well, let's see. This is 3 o'clock in the afternoon. I mean, this isn't bad here, right? So I would want to be aware of this. I wouldn't want to be oblivious to this. We're coming back to that. You get something like that. Well, that's a better trade than you realize, right? Something like there. There's $475 there. Oh, you'll see these, right? I mean, it's tempting to want to put the to draw the rectangle on every one of these, the 150s as well, but you'd have so much overlap, your chart would just be indecipherable. Even here in the overnight, it can be a little because there's so much, because volume really stands out, because you don't have the normal ranges of volume. Well, let's go back a day here and see if we can find something here. Here's Thursday. We remember with the Amazon earnings went absolutely bad shit crazy. Okay, so here's a decent one here, where here we have, oh, that's at noon. Right, so we've got this push down here. Here's the big acceleration. We come down here. Now here's the churn bar, right? These are often very, very close at or very near pivots. We get that churn bar is kind of a heads up. Now we retrace. What are we doing? Right, we're just coming back into all that liquidity that was there at that bar, and then down we go. Right, now we get, so here's the classic. Right, that's why this is the worst place to enter the market. Always, always, always. Never, never, never do that. Well, I would encourage you to, you better really like it if you're doing that. All right, it's just the same as buying any of these pivots or selling into those. Here's the same thing happening here, right? Somebody's buying that on the breakout. Well, so here again, look here. So just to, not to digress, right? I tend to do that. Here, as we get the retrace here, what are we doing? We're just tapping into all that liquidity that was there. Down we go. You say, well, that doesn't look like much. Well, it's probably a measured move. Right? We just ramp it up here. Here's the 50. Well, you didn't get to target, right? Before it broke. Well, you sad about that? What do you got there? Right here from this poof. Now, so assuming you wouldn't take here the 21 period is green and rising, but if you took it on the shoot down, well, there's 81 ticks. Now, let's assume you're not going to get all of it, so maybe a little kickback. There's 250 right there. You'd have been looking for the target, right? It starts to come back at you, so reasonable spot for a location for a stop if you were trailing or just trying to keep from the prior pivot. So let's assume you got that. Well, you still got a nice couple $100 out of that trade. Oh, this one now but again, same concept here. We're coming back into the grab liquidity, right? Where is the liquidity? Well, I know I got a bunch right here. Now as we start heading down, you see the same thing here. Right? We pop down, we come back to it, right? This is still tapping that liquidity here before now I get an this is particularly good because I get an acceleration out of the retest, right? So here's the first one that drives us down. Here's a 150. Now we're coming back into this is just textbook. And again, it looks like another measured move. So if I pull here, right now, if you had the auto fibs or a measured move indicator, it's going to show you those in real time, so you don't have to keep drawing it. But what a gorgeous setup that is, right? Here's the last. So this is up volume here, retapping. You see how this is playing together here? So we're coming down here, we're retapping. Now you could say you're retapping into that sell volume here as well, right? Would not be an unreasonable thing. Well, hey, I've got a lot of sellers here. I'm tapping into that sell volume here before I start to head down. Now here I get here, now I'm coming back here, I'm tapping into all that liquidity here, right? From that red candle, down I go. First target, second target, this one gets third target. So do you see that this is just helping you with trying to identify areas of interest where you know that the market may be active. Right now here again, right, note churn bar right near the pivot. I mean, that is the pivot at the churn bar. Here we're a bar off. Here we didn't get a full reaction here, but that would be a heads up, right? We have high volume, but the market's not doing anything. It's effort versus result. This is a lot of business being done here, relatively speaking, right, from the prior 5 bars. A lot of business being done there, but the markets can't get anywhere. Oh, same concept here. I think this would be most effective to you kind of have to get it on your chart and start identifying it, and all of a sudden you'll start to see it everywhere, which is, well, fortunately, we give you a nice 5-day free trial of all of our indicators. Here it is, swing. We're retracing. We're coming back into all the liquidity of that red bar. Right, down we go. Right, so we hit here on 150, and then it's 150 back the other direction. Now this would, so you could think of it this way. You'd say, well, if I draw that over, right, I still would want to be cognizant of where that volume is. Now here's a big push, right, to try and get out of here. I can't get. Right, even with this big thrust of buyers coming in, they can't get there. So make you think something's there. And I'll let you guess what that is. Oh, let's go ahead and use that one. All right. Oh, either one of these would have been fine. Get it right on that pivot. We use the lowest one. Golden zone. right? So if you're looking there, why? Wonder why can't see if so. That's why it's important. You have to know that's there. Otherwise, you'll buy right into it, right? Here's the swing. Now we're back golden zone, right? The liquidity was there. That's likely some little stop running here or liquidity grab. Now they don't get the target, right? The target is down below. They don't get the target down here because you've made money there. You're not going to get the target every time. There's there's $975 right there. So if you're trailing with a stop, maybe you got that. Maybe you got popped out there. There's 455. Maybe you used the last little pivot as it was driving down. Your stop's here right at that pivot. What'd you get there? There's $440. Single lot. Right. So I think that starts to give you some idea of the value here. So how am I doing on time? Okay, so let me I think you get that. Let me show that with a little bit more in terms of the context of how you might use it. Now here I've just put on, I've instead of just showing the open, I've got our full initial balance on here. So if I scrunch this up, well, let's go back to just so we have another day here. Let's go back to Wednesday, which was when we had the big sell-off. All right, here's the Facebook sell-off. All right, so here, now let's open up the day so we can see it in full context here of a day. All right, again, that we haven't looked at. Well, let me get back to the open. Okay, so here we are at the open. Now, of course, right, you're going to see very high volume at the open. We're just kind of waffling back and forth. I mean, these are pretty big ranges here for the S&P. Now, look what happens here. We've got our 150s, right? And you do the same thing, right, on a 150 and say, well, hey, a lot of times I'll just draw it off the body of the candle, right? Not necessarily the wicks. So as we are driving down here, so look what happens. We've gone for up here. We've got big rejection up here. Big wicks, right? The market is pushing, right? But there's no acceptance up there. The buyers are not being drawn in. So down we go. So you can again just, your eye will start to see these everywhere. What we're retracing into the liquidity that's there, right? We see it down below before we head back down. Now at the low, right? And this is a bit telling. At the low, we have very high sell volume. Now take note of what time it is. Right? Again, for those of you that follow some of our teachings here, and this is a Trade Devils original, right? This is the first test of the initial balance low, right there. Well, pardon me. There's where's 1030, right? So at this bar here, it's 1035. So the IB has been set here, right? This is the lowest bar within the first hour of trading. So here's the push down past the IB. Well, that's on extremely high volume. Now the fact, right? So the large players will use the initial balance as a bit of a determinant as to whether or not we're going to have a range day or a trend day. If we get outside of the initial balance and then we stay below and there's acceptance below, likely we're going to have a trending day. If they can't get acceptance below the initial balance and we come back in, it's more probable that barring some sort of a news event throughout the course of the day, we're likely to stay range bound within or near the edges of the initial balance. So here, one of the things that we want to look for is that when we see a big push like this, right, on very high volume, relatively speaking, and it's right back inside, well, that's the trade we're looking for, because we want to see that rejected. So we come all the way back inside, get all the way back to the open. This is where the market opened. Again, we're kind of back into kind of the same idea. These wicks up here where we have rejection, right? We don't get acceptance up here. Swing down. Now there's a higher low, or pardon me, a lower high here. Right? We swing. Now I can't even make that high. Now all of a sudden, now I got another low, lower high, lower low. Lower low, lower high, lower. So now it's starting. So you can look here and say, well, God, would there be a trade there? Oh, pardon me, that one broke. All right, so you missed on that one. Let's go back one. Is off. Well, pardon me. So this one here, this would have been just a break. So if you're here at the 65, you've been stopped out. But yeah, you get another one right away. Right. So if your stop is on the other side of the 65. You get this one right after it. Here's the 50, right, to the tick. Now note here, as it's coming back in, it's tapping into the liquidity that is on this 150, right? So we come back, we tap that right to the 21 period. There's the target. second target. Keeps going. Let me pull that off here, and I think we'll wrap this up here because I tend to go too long on these. If I can get you another good example. Well, here, I mean, this is not bad here. So this is 1245. Here's a big push on the bar. It's not unlike the prior day. Same thing here. Big push into the bar. We're coming back, tapping that liquidity. This one we get beyond the edges of it here. But then here's a great example. So we're pushing up. We're coming back into that pool of liquidity here from that green candle. Up we go. Now we get 150 here. So we know this is high volume. Now we've got also very high volume. It's actually higher volume. But look, turn bar. I can't get any. A lot of effort is being spent here via the high volume, but the market can't progress. Down we go. Each of these, the reason we want them color-coded is to draw your eye to them. Because you could just keep doing this. You'll just start seeing it over and over again. Okay, well, here's the liquidity here. Now, we go up. We come back into that liquidity. Up we go. We're down. Now we're tapping into it all here. Up we go again. Now, here's the next 150. We're up. Now we're coming back. We're tapping into this liquidity. Up. We're coming down. Oh, now all of a sudden, I got a change of character here. Now the structure has broken. See, the structure breaks right here. Oh, let's see, is this one here. So here, right here, I have the break of structure. So for the first time now, I don't this series of higher highs, higher lows, higher highs, higher lows, higher highs, higher. All of a sudden here, I've got a bit of a tell, and then all of a sudden I get a lower high. Now I get a structure break here. Now I'm breaking the last higher low. Break. What do we come back to? This pool of liquidity and this pool of liquidity before we go again. Now still, right, you're still struggling here. We can't get a higher high, and we get all of a sudden now we're back in sync with. Now you see the McGinley starts to go, the 21 period starts to go green again. Oh shit, you probably got another one right here. A little break here. We're going 786, but up to the top we've got churn bar. Right now we're starting to break, right, and targets are not getting hit, and then that's where at the end of the day, right? This is, well, here's 4 o'clock. This came after the market. So I think that's helpful to you. I think that'll give you the basic idea of it here. If I were putting this into a full template of one of ours, this is what it would look like here. So this is often how I will trade it. So this would be, for those of you that are familiar with our graphical order flow, I think this is a very, very strong contender to add into your graphical order flow. And as I talked about why we're using hollow candles, because we're getting delta aggression inside the bars as well as volume impressions on the thickness of the outside of the candles. And this is the same thing. This is a 20 period volume weighted moving average that I've got through our GAN high-low activator here, which is just another. It's just the same thing as if you were looking back here with a 21 period McGinley. Is the advantage here is that this will fire alerts when it crosses, right? That's the only reason. And then additionally, we put a squeeze indicator in it, so you can see down here on the edge you've got a squeeze. But I also had it designed to put a squeeze on the high-low activator if you didn't have a squeeze indicator or you didn't have our devil's edge. So here you see it. I mean, here's a fairly good example. So here we have. Oh, here we are in the ES at this low. I've got high liquidity here. I've got a very high candle here. I got a very high candle here. The market, even with that sell volume, we're not getting any interest amongst sellers. Right now, you start to see the volume start to ramp. The devil's edge, which is this is a very modified MACD, starts to push outside of the very narrow Bollinger Bands that you see here because of the contraction of volatility. Then all of a sudden, and this is just what you want to see, right? So you're coming out of this consolidation period, which is how the market moves, right? Consolidation, then we move, then consolidate, then move, right? And in this case, we're coming down, then going back up. So here's this little consolidation now coming right out of it as we cross outside of the Bollinger Bands at the MACD, right? So that's what creates this arrow. Then I get 150% of the volume greater than the last 5 bars, and then our cumulative volume is now accelerating and rising. So this on the break here, right? So here, last bar is actually a squeeze. So we had a little volatility on this bar now, but those arrows inside the candle are telling me that the aggression is on the buy side. That's a reflection of the delta within that candle. So the aggression is amongst the buyers are pushing up. Here I get aggression amongst the sellers as a take profit. But down here we keep going. So there's all sorts of potential for how you would use this in combination with other tools. I mean, this is the template I use right here. Right? I mean, this is if I'm trading the graphical order flow, this is the template I'm using. And again, trying to keep it very, very simple. And I've got a bunch of our things on this, all the fib related tools in the measured move, and Devil's Edge, and the full suite of the graphical order flow package here. So there's a lot going on here, but at the end of the day, it's about drawing it. The reason this complements so well is that down here where I'm getting a cumulative tally of buy-sell volume, I don't get to see within the bar the same way, and I can't make a distinction between a high volume bar here relative to prior bars. So what it's doing is just drawing my eye to it. So as you look here, this high volume candle right here as we pause here, here's your churn bar. We're coming back down, and we're literally just right to the edge of it, right to the top of it here. We're getting that. We're just tapping it here. So note, and there's that is just a 20 period volume weighted moving average is what I have running through the activator here. Now, little consolidation. So we got squeeze, 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 squeeze. Now there's one last little pop up here, big pop up. Note, right, the market here doing this at, it's 145, immediately rejected with that same amount of sell volume. So this is, the market is unsure what it wants to do here. So if it's just the same idea, right? It's not complicated. You just pull that across. So what do we see here? We got a lot of consolidation. The market's unsure here. Here's the squeeze. Now look below, right? All of a sudden we're heading down here. We break the 20 period volume weighted moving average. An alert fires. There's the little arrow here as it breaks below as the MACD breaks below the Bollinger Bands. The squeeze ends. The vector goes red. So you've got a lot of things happening here. Now we're going back the other direction. Now note here again, same thing. So here's a big green candle right here. So you see it right here, this candle here. So we go up. Now we're coming back here to tap into that liquidity, and then off we go again. Right, very, very powerful, and I think you'll find it'll complement whatever you're using here to give you further insight into what's happening and where the big players are going to look for a return to that liquidity so that they can use it to get their orders filled. Right? I mean, here's what a spectacular example this is. Right, we're taking this whole thing and then just pulling it off to the side. I mean, I'll bring that down here, right? So we get this here. So we're coming, here's the high volume bar. We got another high volume bar here. This is all big sell volume here. So as the market is coming back up, I mean, God, can it be any more in your face? Right here, we're coming all the way back down here. I got lots of liquidity down here, but the market is now running out of steam all the way back up here to tap into the volatility, tap into the volume that was right there. Right, so it becomes a target. Now you get it right here. So you just, that's why you want to be mindful of where these are. You could say, oh, you got it right there. You tapped into a little bit there. Did we? Well, do we want to be selling right here? Right. I mean, look where we are. Right. Look at the MACD, the volume. You've got volume accelerating, the volume weighted average. Now up here, maybe there's a scalp there. Maybe as you broke here, that's more than you think. That's 29. That's 28 ticks. 337 here. I mean, you're not going to get all of that. Say you took the break here on the acceleration bar. There's 22 ticks. Not a bad little scalp. Consolidation. Where do we start to accelerate? Now we're getting, here's 1 o'clock. Right, another good example. Right, we just looked at this. Right, so here's the push. Here's the churn bar here. What are we doing? Right, market's not sure. Are we gonna hold up here? We're gonna find acceptance. Here's the next. Note the internal arrows. Right, if you're familiar with the graphic order flow, you know that means the delta was very positive there. So buyers were aggressive. Up we go. Then we get the divergence here at the top. So you see dramatic volume divergence here. There's a lack of interest amongst buyers. Pulls it back. Okay, there you go. I think that gives you a handle on how this can be useful to you. It will be infinitely more powerful when you put it on your own chart and then start to recognize and look for those opportunities where you see the market move one direction, and if you're not in that direction, which is often the case. We want to look for the market to show its hand and then retrace to get back into that liquidity and then carry on. Right? So this is not the trade we're necessarily trying to identify. It's this trade here, which in this particular case here, once we're back into that liquidity and we start heading down, well, there's another 22 ticks. Right? And you're right in sync, right? You want everything to be lined up. So I see sell volume coming. I'm coming out of a squeeze. I'm below the volume weighted moving average, right? So I know sellers are not pushing here. Now look at the MACD is going outside of the Bollinger Bands, and the cumulative volume total is now accelerating here to the down. And all I do is come right back into where I had the prior liquidity all the way back on that bar, which was tied to this candle. Very, very consistent phenomenon, something that I'm sure will help you if you start paying attention to it. Now you can do what I used to do before we created this. I would just draw this, right? So every time I saw a high volume candle, I would draw something across saying, well, hey, I got to pay attention to that. Well, eventually we just decided to code it in because we figured it would help people. And I mean, if we're going to use it, we want to make it available to you because we think it'll help you. Okay, there you go. 5-day free trial, as it's the case with all of our indicators. All you have to do is request it. Go over to Trade Devils-Indicators, and that way you can run it for 5 full trading days. See if you get as much value as I think it has to offer to you. All right, guys, there you go. I hope you enjoy it.